Hey, it's July and nobody wants to sell houses any longer. What do I mean by that? Well, you're going to see it's actually pretty interesting. We had declining inventories throughout the month of June here in the Las Vegas Valley. I am Justin Miller with the Chong Miller Group. At the Chong Miller Group, we help people buy and sell homes. We help people build wealth through real estate. This is the July 2025 real estate market update for the Las Vegas Valley. So a little bit shorter video, a little more condensed, but all the important information. So let's go ahead and dig right in. As I mentioned, this is the July 2025 real estate market update video. That means I'm looking at data for the multiple listing service as well as a few other sources from the month of June 2025. And I did capture this data on the 7th. I'm recording the video on the 7th. I hope to get it posted today on the 7th as well. All right, so let me give you just a real quick insight about what's going on in the macro environment that is unquestionably impacting real estate here in the Valley as well as actually across the entire country. All right, so just prior to July 4th, Congress managed to pass what had at one time been called the One Big Beautiful Bill. Kind of interesting, the Democrats scored a significant victory in the Senate where they were able to strip the name off the bill. So it's the bill that used to be called the One Big Beautiful Bill. I think that says a whole lot about what's wrong with the Democratic Party right now, that was a major victory for them. I think as well, we see in this bill a whole lot of stuff that's wrong with the Republican Party right now. We've got lawmakers who are not reading what they're actually enacting, and we've got a lot of junk in here. There's one really good note with regard to the bill that used to be called the One Big Beautiful Bill, and that is the debt ceiling was addressed. The debt ceiling was increased by $5 trillion. Now that's significant. It's a massively big increase. The good news is it was increased, it was addressed, because if that had not been dealt with, we would have been staring down the possibility of the US government defaulting on its debt. Now, there's been a lot of talk over the years about how 2008 could be repeated and we could see housing prices collapsing and blah, blah, blah. In reality, 2008 was not a housing collapse. That's not what it was. It's misallocated to housing. In reality, it was a global financial crisis. The global financial crisis was precipitated by a really big mistake, massive mistake from the US Federal Reserve. They allowed Lehman Brothers to collapse. And what happened was that destroyed notional value of contracts between all of the investment banks, commercial banks, large businesses, the federal government, etc., to collapse in on themselves, where there was no longer any ability to assess counterparty risk and counterparty trust. That caused the entire financial system to come to a grinding halt. Now, there were things that were going on in the financial system that had led up to the collapse of Lehman Brothers. Some of them were really negative. Some of them were housing problems here in the Las Vegas Valley as well as in Phoenix. But this was not precipitated by housing issues. This was precipitated by a massive miscalculation from the US Fed. Well, the thing to note about it, because right now we do not have a housing market that looks anything like we did in 2006, 2007, where we had significant oversupply. Now we have significant undersupply. But because it was actually a financial crisis, we could put ourselves back into a financial crisis. The implication for housing, a little bit unknown, except that it would probably grind housing transactions to a halt, as we had seen in 2008, not the pricing coming down, but rather the number of transactions just stopping. So anyhow, if the US government defaulted on its debt, that would precipitate another global financial crisis. Fortunately, we've overcome that issue, so we no longer need to worry about that. Now, there are a lot of other things in the bill that are good, and a lot of other things in the bill that are really bad. We don't need to dwell on those things here. That's a topic for another video, probably on another channel. I did want to note, however, to you the The debt limit has been resolved, and so that is no longer a problem overhanging all of us and any portions of the market. Okay, but what does this mean about interest rates? Interest rates, we know, have had a major influence on housing across the Las Vegas Valley and, in fact, across the entire country over the past multiple years. As interest rates had come very low in 2020 because of attempts to, if you will, keep the economy moving during the pandemic shutdown, those very low interest rates caused, in part, a significant uptick in the number of transactions in real estate assets. Well, the Fed kept interest rates too low for too long, really resulting in some significant increases in inflation. And then the Fed finally decided to increase interest rates. They increased them too quickly, too far, and they've held them high for too long. In 2024, we started to see the Fed lowering their policy interest rate, and they lowered that policy interest rate by 100 basis points. That had a very short-lived impact on mortgage interest rates. And I just want to note here, remember, the Fed does not control mortgage interest rates. They simply signal the market what the Federal Reserve would like the direction of interest rates to move in. The problem now is the Fed is faced with inflationary impacts of tariffs, and those are coming. Right? Remember the inflationary impacts of the COVID lockdowns. Those started early, the lockdown started in March of 2020. We did not see those inflationary impacts until the beginning of 2022. So these things take a while to work through the economy. I would expect we start seeing them this summer, but it could be next year before we actually start to see those inflationary impacts. But they are absolutely coming. There's also high levels of uncertainty. And in the what used to be called the One Big Beautiful Bill, we've got at least $3.5 trillion of additional debt spending. That likely is going to cause the bond market, where mortgage interest rates get set, as well as treasury interest rates and car interest rates, etc., to push down demand, causing prices of those bond assets to fall, which causes interest rates on bonds to increase. Remember, bond interest rates increase as bond prices fall. So interest rates are inversely correlated with bond prices. So I think rather what we need to be concerned about right now is, irrespective of what the Fed might want to do, the bond market itself is going to be pushing interest rates higher, quite possibly starting within the next month or so and continuing for multiple years. So the interest rates that we're seeing now, right around 7%, likely these are, going to look like pretty good rates to you when you're a year out, 2 years out from now. Now, what did interest rates actually do in the month of June? They were volatile as they've been in the month of May and April and every other month this year, but they've been fluctuating just below 7%. And so we've been down to 6.8, we've been up to 7.05. Interest rates have been hanging out in that 6.95 range, and they continue to in the month of June. Actually, if you look year over year, we're actually down 1 basis point. That means 0.01% on mortgage interest rates and on treasury bond interest rates. So we're sitting at the exact same place that we were last year. Now, kind of interestingly, we did see an uptick in mortgage activity last month and actually for part of the month of June, but that's been almost exclusively on the refinancing side as opposed to on the new purchase side. New purchase applications have been basically flat for the entire month of June. Okay, so that's the background, right? Interest rates are the background for the real estate market, as well as the larger macro issue with regard to the bill formerly known as the One Big Beautiful Bill. So let's go ahead and dive into the market dynamics themselves for the month of June in Las Vegas real estate. Prices, single family home prices increased, Right, a lot of people have been talking about how prices are going to be collapsing, the world's coming to an end, blah, blah, blah. Prices are not collapsing. We had seen for 5 months, 4 or 5 months, I forget right now, of 2024, single family median sold price was 470, and we've seen for almost every month of 2025, median sold price has been 475. Well, median sold price in June went up $4,000 or 0.8% to 479. Kind of interesting. That is actually up 1.9% year over year. So again, we're seeing prices have moderated, they've flattened. They're definitely not going down. There's some upward pressure on pricing, but it's moderate. Okay. Now I will put in a note here just to remind everyone, this is resale only. I look at resale only. I segment out all of the new construction that somehow makes it into the MLS because those are different. They're a completely different type of thing. They're noise in the data. Just to give you the piece of information, the new construction that did happen to make it into the MLS, it had a median sale price of $528,048. That's actually down 2.6%. If we factor that in and just say all of the data in the MLS instead of just resale, that took the median sale price in the MLS up to $485. That's actually up 1%. Now you may ask, how do we actually see the new construction part included in that data, the full of the MLS, go down, but we saw prices go up if we include that? It's because the number of new construction homes that were included in the MLS and that sold went up. And so that higher median sold price on those new construction homes caused the overall number to increase. Now, the interesting insight with that is we can have new construction home prices going up or down. It's going to have some impact, outsized impact on the median price for resale. We cannot predetermine what that's going to be, and so we can't just say, oh, it's always going to result in this level of an error. We've got to factor out the new construction stuff, and so that's what I do for you every month. I look at the resale data only, and resale data went up to 479. Now, kind of interestingly, this is actually only $1,000 higher than the peak that we had achieved in May of 22, and again once last year at 480,000, not inflation adjusted. But so we're hanging out in this sort of flat channel just below the peak median sold price that we've ever seen in the Las Vegas Valley. Prices are not going down, they're holding up well. Well, what about with regard to condos and townhomes? Condos, we saw prices come down. We saw prices come down to 240,000. That's down 9,000 from a little spike that we had seen last month. In other words, it's down 3.6%. Now with condos, we are actually down year over year because we had seen a spike last year in June as well. As we did in May of 2025. And so we're down 5.8% year over year. If you average these out over a quarterly basis instead of just looking at the month data to take some of that randomness out, we actually see the condo prices are just basically flat. You're going to see a little bit more evidence of this in just a minute, but what about townhomes? Well, townhome prices bounced the other way. Median townhome price sold went to $345. That's up $5,000 or up 2.3%. Year over year, townhomes perfectly flat. Okay, and so this is actually what we're seeing in both the condo and the townhome market is flat prices. In fact, pretty much in the single family homes, prices are just flat. They're just hanging out at the level at which we've seen for the past year. Okay, so any movement up or down, there's a certain level of randomness in what happened to have closed. There's a certain level of reality that market prices have a slightly upward bias but that's where we are. Now, I do want to note price per foot. I look at that to give us a forward indicator or to let us know what may be going on across the different segments of the market. So upper half of the market, lower half of the market come down 0.4%. So basically flat on the price per foot for median sold. Now, that's interesting because we had seen earlier in the year that the price per foot was going up and it looked like strengthening in the upper portion of the market. We saw last month price per foot had come down, and in May as well, price per foot had come down, but very marginally, suggesting that actually all of the market is feeling a bit constrained and there's not really any differential between the upper and the lower halves of the market right now. Okay, so now let's look at the demand numbers. And the demand numbers, remember, that's sold. That tells us how many buyers were actually demanding houses and were willing to get into contract and see those contracts through. So that's how we measure demand. Now, demand was really interesting in certain respects last month in June of 2025. It wasn't good, but it was interesting, right? So demand has come down. And I want to point out to you, I want to preface this demand discussion. Prices are basically flat year over year, literally flat year over year for townhomes. Down a bit for condos, but that's just because of when we've seen spikes in prices on condos and things have come down on them. But basically flat for condos. And yeah, we're up $4,000. We're up 1.6% year over year for single family homes. We're basically flat for pricing, right? So that can be understood as if pricing is flat, there's no reason to see demand deteriorating. Right? There's no reason to see necessarily demand accelerating, but if prices are flat, they're the same thing as they were last year. We should see the same dynamics as we saw last year. Interest rates are flat. I told you they differ by 1/100th of a basis point. That's a carry cost of a few cents. So interest rates are flat year over year. So interest rates should not be causing an acceleration or deceleration in demand. What is? Well, the only thing that's left, if interest rates are flat and housing prices are flat, the thing that's causing a decrease in demand is not that houses are going out of style. It's that there's too much uncertainty in the environment and it's causing buyers and maybe sellers, and we're going to see that, it's causing buyers to hold back and I can't make a decision. I don't know what's going on. I don't know if I'm going to have a job. I don't know if I won't have a job. I don't know if I'll have health care. I don't know if I won't have health care. I don't know if my costs are going up for everything. I don't know if my costs are going down. I can't make a decision, right? High levels of uncertainty are debilitating. And that's what's causing demand to pull out of this market. It's not impacting prices. It's not being impacted by interest rates. So let's look at what demand actually has done in the month of June of 2025 relative to May and relative to last June. So sold single family resale, 1,767. That's down 161 from May. That's down 8.4% month over month. That's a pretty big hit to demand, 8.4%. We're also down 4.9% year over year, right? Remember 2024 was the second weakest year we've had in a generation, and actually it was tied for the weakest in the first half of the year. So this is down from where we were in 2023 and 2024. This is a really low number of transactions in the single family resale housing space. Right? Remember that accounts for something like 82% of the overall market for houses in Las Vegas. It's a very significant portion of the market. Demand has come down. It's come down 8.4% in the month of June relative to May. It's come down from last year. That's really bad. And then superimposed on top of that June. That should be the strongest month of the year in terms of normal seasonal movement. right? That's the end of the spring, beginning of the summer selling season. We're down 8.4%. That's weakness in the market. Not because of price. It's not because of interest rates. Those are flat year over year. Well, what about for condos? Condos, 231. That came down 12 from what we saw in May, or 4.9%. We're down 34.2% year over year. Where are the condo buyers at? Right? Condos, June 2025, resale down 4.9%. Well, how about townhomes? Are townhomes better? No. Townhomes, 211, down 28, down 11.7% month over month, and flat year over year, right? Last year, really slow volume. We're flat. And that's the best submarket that we've got in June is townhomes. Prices went up, sales were flat year over year, but they're down 11.7% month over month. Real weakness in demand being driven by massive levels of uncertainty in the marketplace. Now, I do want to make one other insight here for you, or note one other insight here for you. And this is kind of interesting. This tells you something about the relative health of the market between single-family townhomes and condos. We know last year I did the math that the single-family home submarket is a little over 80% of the overall market of houses in Las Vegas. The condo market, something about 13%, and the townhome market is a residual, something around 8%. In June, sales for condos, sold condos, 231, townhomes, 211. June was such a weird month that we actually had the gap between the 13% of the market and the 8% of the market, 7% of the market, shrank to 20 units. Okay, so what about pending contracts, right? Those are buyers and sellers who've gone into a contract showing buyer demand, but the transaction is not yet closed. So pending gives us an idea of demand going forward in time. Well, up slightly for single-family residential, but down slightly for condos and townhomes. There's no real change in the overall market number there. So pending contracts are not looking great for the month of July. It looks like we'll probably end up going down in the month of July as well. So these are not normal seasonal patterns. We should have seen strengthening in pending and significant strengthening in actual closed transactions. Okay, so that's the demand side. Now let's look at the supply side, right? The supply side is even more interesting. Now you'll recall that we've had several discussions over the course of the last couple years about how supply that should be coming into the market, and that the real old timers, the people who've been doing this 20, 30 plus years, have said supply always comes back in the spring. And I've been suggesting we don't have a normal pattern taking place here, and we did not in 2021. We did not in 2022, in 2023, in 2024, and we do not in 2025. That's not at all what we're seeing. You've also been hearing a lot of news about inventory flooding the market. There's so many houses, the housing market's going to collapse because everybody's trying to sell. Well, let's see what the reality of the situation is, because it's neither of those things. It's bad, but it's neither of those things, okay? Inventory, this is for sale, listed for sale, meaning in the MLS. It had previously been listed at standing inventory for sale in the Las Vegas Valley for resale homes, single family homes. 6,988. Down. In June, down 144 units, or down 2.0% month over month. It's up a whole lot from last year, where again we've had really weird numbers last year because inventory was so incredibly tight in the first half of the year of 2024. So we're up 40.7%. We're actually up less year over year than we were in the month of May, which is kind of interesting. We see this duplicated in condos and townhomes. You'll see in just a second. But the gap between last year and the current year shrank, even though it's a really big increase of 40.7%. But we're down. Came down 2.0%, 144 houses, single-family resale residential in the Las Vegas Valley in June. What about condos? 1,596. We are down 64 condos, or 3.9% month over month. And again, we're up 35.8% year over year, but again, that's a smaller increase year over year than what we saw in May for condos. So that gap over last year is starting to shrink. Well, what about townhomes? Same kind of thing. 1,043, down 25, or 2.3% month over month. We're up 92.4%, really big increase over last year. Again, a smaller increase over last year than what we had seen in the month of May. So the gap between last year and this year for inventory is starting to close, slowly, but starting to close. But inventory literally came down in June. And it did it during a weak sales month, right? So it's not like everything's been snapped up and purchased. It came down even though sales were coming down. Inventory came down. Well, remember, this is the reported inventory. This is what it says in the multiple listing service if you just decided to go and search for all of the inventory, all of the houses that are out there. For the past several months, I've been showing that that's actually it's a fine way to do some research to give you a global understanding of what's going on, but it's not how people actually search for houses. If you wanted to buy a median home, right, you're probably looking for something between, say, 350 and 550. You're probably looking for something that's like 3 to 4 bedrooms. You're probably looking at something that's 2 to 3 bathrooms, 2-car garage, et cetera, right? And you put your search parameters into wherever it is you're doing your search, and your real estate agent does the same thing. They put their search parameters into wherever it is they're collecting information from, MLS, homes.com, realtor.com, Zillow, whatever it happens to be. And they come up with the smaller group of homes. And then they start to look, well, only in this particular geographical area, and maybe with only this feature, maybe only with a pool, or only not with a pool, or maybe only in an HOA or not in an HOA. And the number starts to become a lot smaller. Well, what does not show up in that kind of a search? Hugely mispriced houses. They don't come up, right? If a house should have been $479 and it's listed for $600, it's not coming up in your search because the search is bounded. So those things I'm referring to is fake inventory. Yes, they're listed for sale. Yes, some real estate agent got a listing and put a sign in the yard. They're listed for sale, but they're fake. They won't sell. They're way overpriced. They just don't relate to the market. So for the past several months, I've been doing research to see, well, how does the quality of the listing inventory actually look? And we've been finding there's a whole lot of fake inventory out there. Well, what about in June? Median list price for single family resale homes was not $479 or $480 or $485. It was $561,223. I will just tell you as a side note, this actually, when the total inventory or total sales or total whatever goes over 5,000, it's a lot harder to capture this information. It's doable it requires a lot more work. I think it's fascinating, and so I'm doing it, and I'm giving this to you because I also think it's really important, but it becomes harder to actually collect the data and analyze it this way. Anyhow, that $561,223, that is over $82,000 higher than the median sold price, right? So your median list stuff and your median sold stuff, right? Now there's an overlap. How big's the overlap? Well, if we normalize the listing prices to sold price, right? There's a statistical way we can do it. What it means is that we actually have a real inventory. This is single family homes only, not of 6,988. It means we have a real inventory for single family homes at the end of the month of June of 2025 of 2,112. That's less than 20% of the inventory that we should normally have in the market at this time. So inventory is incredibly tight, less than 20% of what we should have, what normal inventory would be in the market at this time. And of all of that inventory that's listed out there, it's less than a third, it's 32 point something percent. Less than a third of all that listed inventory is actually real, right? The rest are just gonna sit out there and sit out there and sit out there, and maybe somebody will come along and lower their list price. Great, maybe they'll lower their list price several times to finally make themselves real inventory. That's great. And then somebody will have a headline, prices are falling. Prices are not falling. List prices might be falling because they're not related to reality. The reality is the market clears at the median sold price, not at the median list price. The median sold price went up. It's about flat, it went up slightly. Sale prices are not falling in Las Vegas, regardless of what's happening on fake inventory. Okay, but I also want to point out to you, the real inventory fell significantly in June relative to May, and even that fake inventory fell, right? Single family homes, inventory down 2% overall. That's the fake inventory is also falling. Contrary to everything you're hearing from all the doomsayers out there about how inventory is exploding, everybody's selling, everyone's trying to get out, and everything's going to crash. Prices are not going down, and inventory is actually coming down. Marginally, but it's coming down. And real inventory is incredibly tight. Okay, one other statistic I give you every month, and that is back on market. These are the pending contracts that fail. Instead of closing, they fail and go back into the market. So there's an undercount here. The failed contracts that do not go back into the market, I don't capture them. It's hard to capture that information. It requires a lot of extrapolation of a lot of data where the noise becomes so great, it overwhelms the insight that we could actually glean from trying to add it back in. So for back on market, it's a way I measure failure. So single family, 761 contracts failed in June of 2025. That's 30.1% of all of those contracts that were written fell out. Buyer and seller go their separate ways, licking their wounds. Astoundingly bad, 30.1%. Condos, 112 failed condo contracts in June. That's 32.7%. Just less than a full third failed and came back in the market. Townhomes, 91, 30.1% failed for townhomes as well in the month of June. Horrible news. A little bit on the higher side of, but within the range of 25 to 33% that we've been looking at since the fourth quarter of 2020. So we're almost 5 years into this astoundingly horrible situation of all of these contract failures. Make sure when you're talking to your agent, you find out what's going on. Talk to us. We'd be happy to help you. We protect our clients from failed contracts. We protect our clients really successfully from failed contracts. Our failed contract ratio is less than a tenth of what these numbers are that we're seeing in the actual in the overall marketplace, right? 3%, something like that. Someone loses a job, it's going to be a failed contract, right? There's a couple things that cannot be controlled for, but most of it can be. This is bad, really bad. It's agents allowing clients to get out of control and not focus on what they're actually trying to accomplish. It's allowing agents to make bad recommendations with regard to pricing. It's bad with regard to agents informing their clients about what should be or what should not be included in inspections. This is overall bad, and it's a poor reflection on the state of the real estate industry. It's a poor reflection on the state of practitioners in the real estate industry. And frankly, it's also a poor reflection on those who should be listening to inform people in the real estate industry, right? This is just all around bad thing, right? So what have we got going on? The summary is prices are flat to slightly higher. The demand is definitely significantly down. Inventory is down even further, and real inventory is tiny. It's less than 20% of what we should have in this market. So I am Justin Miller with the Chung Miller Group. At the Chung Miller Group, we help people build wealth through real estate. We help people protect themselves through real estate transactions. We help people build wealth through real estate. Please reach out with your comments, your questions. Be happy to interact with you. Be happy to represent you in your real estate journey. And I'll see you in the next month. Bye-bye.